Over the past few years, financial markets have been subject to unforeseen circumstances that have produced declines in returns and excessive volatility. Often these periods of uncertainty see investors searching for alternative assets to diversify their portfolio and reduce the risks associated with the financial market as a whole. Precious metals, in particular gold, offer an attractive method for hedging against market volatility in these instances. But to what extent can precious metals be relied upon as safe haven assets? Recent economic upheaval, namely the COVID-19 pandemic, has triggered turmoil in financial markets, soaring inflation rates, and drastically increased uncertainty regarding the recovery of the global economy. Fiscally stimulating policies, including lowered interest rates, made borrowing cheaper and encouraged spending to bolster resurgent economies that were struggling with post-lockdown slumps. Higher commodity prices have intensified the threat of long-lasting high inflation and its subsidiary risks of stagflation and social unrest. Suffice to say, markets are in a state of flux, and natural resources like precious metals tend to present an inherently stabilized alternative for investors for a number of reasons. Gold offers a store of value and plays a major role in the development of monetary policy set by banks. On the other hand, silver, platinum, and palladium are used in a multitude of industrial applications, including vehicle, electrical conductor, and medical device manufacture. Thus, during volatile periods, there is a resultant flight to quality effect, as investors' effective risk aversion increases and safer assets that represent tangible rather than speculative value, become relatively more appealing. My name is Jeremy Tasker, and with me I have Aashnavy Sanan, Flynn Mahoney, Kaylyn Chan, Leann Duff, and Rowan Chong. We are Group 9, the All Ridiculously Intelligent Mathematicians Association. We have chosen to investigate the safe haven property of 4 precious metals, gold, silver, platinum, and palladium, and to assess their relative strength in terms of mitigation of market volatility. Our group conducts volatility modeling of these precious metals before analyzing the geopolitical risk, inflation, and volatility indices.
Before we continue on with our specific investigation, our group conducted several literature reviews to establish familiarity and understanding of the research already available regarding the stock market for precious metals. The first article investigates the value at risk and statistical properties of daily price returns of 4 precious metals, gold, silver, platinum, and palladium, between the years 2000 and 2016. This was achieved through a complex 2-phase methodology which involved testing a combination of Garch-type models and applying the extreme value theory. Under the generalized error distribution, the conditional variance was modeled using a range of univariate Garch-type models such as Garch, E-Garch, and T-Garch. The extreme value theory was implemented to capture the behavior of tails in the distribution of standardized variables. The findings of this article suggest that precious metals are characterized by fat tail distributions, volatility clustering, as well as leverage effect behavior. By using the 2-phase approach, the researchers were able to predict one-day ahead VARs in precious metal markets to compare with the Garch-type models. The comparison of the dynamics of VAR demonstrates that gold outperforms other precious metals as it has the highest and most stable dynamic VAR, whilst palladium has the most volatile dynamic VAR. The key takeaway from this article is the necessity to adjust risk management metrics for precious metals as the prices of precious metals are more volatile than their historical trends. Overall, these findings reiterate the features of precious metal returns, such as volatility clustering and asymmetric behavior, as well as employing filtering processes such as the extreme value theory approach, improves hedging strategies and the assessment of risk management.
Similarly, Bauer and Smalls analysed the relationship between geopolitical risk and asset price, isolating the differences in responses of precious metals and other assets. They utilised the geopolitical risk index to extend on previous approaches, which had primarily operated with methods such as the Economic Policy Uncertainty Index, as it allowed for the inclusion of a greater range of geopolitical events. This meant that they were able to create a quantitative measure that was both tractable and auditable. The first set of analysis followed a simple log-log regression of the daily return of each individual metal: gold, palladium, platinum, silver, copper, on the logged first difference in the geopolitical risk index. They also included an intercept and error term. In the second model, Bauer and Smalls included an additional regressor which captured a set of macroeconomic state and market control variables. They carefully delineate between a hedge, an asset whose return are positively correlated with changes in geopolitical risk, and a safe haven whose returns are positively correlated with changes in extreme geopolitical risk. Ultimately, Bauer and Smalls find that precious metals are hedges against geopolitical risk in general and geopolitical threats in particular. Interestingly, in the case of extreme geopolitical risks, only gold and silver were able to demonstrate significant safe haven properties.
Finally, A.R.I.M.A et al. Examine in-sample conditional volatility analysis of precious metals by using regime-switching gauge models. Fitting 72 ms gauge models to the log returns of each of the four most precious metal, gold, silver, platinum, palladium, A.R.I.M.A et al. Tested in-sample analysis of volatility and compared them using the Akaike information criterion. In doing so, they assessed the best models for all precious metal series. They additionally conducted one-day ahead value at risk forecasting by the best MS gauge, which suggested a number of important results. Firstly, the existence of regime changes in the gauge process was detected in most cases analyzed. Secondly, regime-changing gauge models were expected to outperform single regime gauge specifications when predicting the value at risk. Crucially, however, their results indicated that the best suited models for gold and silver are GJR gauge and S gauge, T gauge, E gauge respectively, whilst the best suited models for palladium and platinum are S gauge, E gauge, and S gauge, T gauge respectively. Although regime switching gauge models are outside our purview, this paper brought to our attention the possibility of conducting tests such as GJR gauge, which ultimately proved the best candidate in some instances during our own modeling process.
Thanks, Aashnavy. We will look at data descriptions in terms of data collection, cleaning of the data, and the challenges we face. We considered the daily returns of gold, silver, platinum, and palladium in terms of US dollars from 2018 to 2021 to determine whether they exhibit safe haven-like properties through its volatility. The period of 2018 to 2021 was selected since it combines a period where volatility was low compared to the duration of COVID-19, where volatility was relatively high. This was before major geopolitical events such as Ukraine war, but the start of high inflation due to global supply chain issues. While considering these precious metals returns, the returns are skewed to the left as expected. Additionally, we considered the Index of Global Geopolitical Risk, GPR, and the daily changes in the Index of Market Volatility, VIX. Since high volatility in the rest of the market, combined with geopolitical risk, will drive higher prices in precious metals, since these assets are viewed as a hedge against volatility. While G20 monthly inflation was considered, since gold specifically is known to be a good hedge against rising inflation. The challenges we faced in terms of data was missing data across all the precious metals, which we applied cubic spline interpolation to the data by constructing a piecewise third-order polynomial using existing observation.
Additionally, the other data challenges we faced include differences in frequency of data, such as GPR and G20 inflation index, which are monthly instead of daily. Additionally, G20 inflation data was selected instead of global inflation since the data was unavailable. While G20 inflation is a good alternative variable, the data is from OECD instead of individual countries. Furthermore, some countries report inflation data quarterly while some countries report it monthly. Therefore, interpolation would have been required for countries that report quarterly data, thus adding to the error that it should be minimal.
Thanks, Rowan. Before we were able to begin fitting any models to our data, we carried out some necessary tests to further understand the nature and dynamics of our data sets. We ran augmented Dickey-Fuller tests on the daily return series for each precious metal, and the results confirmed that the series is stationary, that is, they do not contain a unit root. Results of the Young box test for serial correlations in squared residuals and the arch effect in these residuals confirmed strong evidence of serial correlations and heteroscedasticity for all four precious metals. We then plotted the ACF and PACF of the return series and found varied significant lags for each precious metal, which we used to define our A.R.I.M.A PQ parameters in our model specification. Our primary focus was on gauge modelling due to the serial correlations, arch effects, and volatility clustering present in our data. We looked at fitting many different models and narrowed it down to E-gauge, S-gauge, and GJR gauge in light of our research into the relevance of various models to our research question and to our datasets. Before deciding on which gauge model to use to model the volatility of precious metals, we ensured that the key assumptions that underpin the model were met. We have already demonstrated that the series is stationary, and confirmed the presence of volatility clustering and heteroscedasticity. We proceeded to fit our models and also found that our Garch models are mean reverting and conditionally heteroscedastic, but do have constant unconditional variance. Here is the table for each model and each precious metal with the corresponding information criteria that we looked at. We double-checked the plots of the residuals and ran Young box tests on the squared residuals to determine the goodness of fit and to decide which model would be most appropriate for our volatility modelling. In addition, we investigated VIX, GPR, and G20 CPI inflation. Co-integration tests between VIX and each of the precious metals were particularly interesting, and we found that all 4 combinations demonstrated co-integration using a Phillips-Aurelius co-integration test.
Thanks, Leann. Now we'll move on to the discussion of the most suitable model for each metal. Let's start off with silver. As seen in the table, the GJR Garch model has a smaller AIC value compared to the eGarch model. However, the eGarch model has a smaller BIC value compared to the GJR Garch model. These opposite effects on the AIC and BIC are indications that both models are relatively similar and suitable. However, as BIC is parsimony sensitive, the eGarch model is slightly preferred over the GJR Garch model, as the BIC tends to favor models with fewer parameters, and thus eGarch would be more favorable in the context of our investigation. The A.R.I.M.A order was determined through visual inspection of the ACF and PACF graphs. In addition, the justification of eGarch as the more suitable model is influenced by Zhang and Zhang's 2016 article and Naeem et al.'s 2019 article, as the eGarch model was seen to predict critical loss very well in the former and was the best candidate for silver in the latter.
As seen under the robust standard error table in our R output, the gamma is positive and statistically significant. Therefore, a strong argument can be made that the leverage effect is present.
Upon running an S-Garch model for platinum, we found that there were no serial correlation in an A.R.I.M.A 2.0, as well as no serial correlation in the squared residuals for an A.R.I.M.A 1.4. We decided to run the S-Garch model as seen in Naeem et al. 2019, which saw that an S-Garch model was the most appropriate model to use with platinum. The A.R.I.M.A 2.0 presented a lower AIC value compared to the A.R.I.M.A 1.4. When comparing the BIC values, the A.R.I.M.A 1.4 had a smaller value compared to the A.R.I.M.A 2.0. The small discrepancy between the two fitted models indicate a likeness in suitability. We determined the A.R.I.M.A 2.0 process by analysing the ACF and PACF graphs and arrived at the conclusion that by comparing the AIC values of both models, we can say that the A.R.I.M.A 2.0 is the best fit when running an S-Garch model with platinum.
Upon running the GJR Garch model for gold, there appeared to be no serial correlation in the squared residuals for the A.R.I.M.A 4.0 model. The A.R.I.M.A order was determined by visually inspecting the ACF and PACF plots generated. The inspiration to utilize a GJR Garch model is attributed to Naeem et al.'s 2019 research article, which found that the GJR Garch model was most suitable for gold. As seen under the robust standard error table in our R output, the gamma is statistically insignificant. Therefore, only a weak argument can be made that the leverage effect is present. As for the palladium, we can observe that the values of the AIC and BIC are lower in the S-Garch model compared to the E-Garch model. This suggests that the S-Garch model best fits for palladium. There are serial correlations in the A.R.I.M.A 1.0 for both the E-Garch and S-Garch model. As mentioned in Naeem et al.'s 2019 article, palladium shows similar behavior which are closely related to silver, indicating that S-Garch would be more suitable for predicting the data. By observing the ACF and PACF graphs, the A.R.I.M.A 1.0 was identified and that the S-Garch model was best used for palladium. This is supported by the use of fewer parameters to estimate.
After modelling the volatility of the precious metals and looking at the co-integration, we fitted dynamic conditional correlation Garch models to further analyse these relationships by looking into whether the changes in these indexes had significant impacts on precious metal returns. We ensured that the sum of the DCCA and DCCB parameter estimates were less than 1 so that our model was appropriately specified, and looked at these parameters to determine whether the indices had statistically significant short or long-term impacts on precious metal returns.
Our research results echo those of the literature we reviewed earlier. It indicated that the GJR Garch model was optimal for gold, whereas silver was best modelled with the eGarch, as supported by Zhang and Naeem et al.'s research. However, the best model for platinum and palladium volatility was the S-Garch model. Having utilized our information criteria to select the most appropriate model for each of the precious metals, we then compared each of their outputs, ultimately concluding that palladium suffered from the most volatility while gold was the most robust. Finally, we employed several DCC Garch models to interpret the relationship between each of our indices and the precious metal returns. Our results indicated that all 4 precious metals offered a hedge against the geopolitical risk and volatility indices in the short term only. However, against inflation, all metals provided a hedge in the short term, but gold was alone in presenting long-term safe haven properties. From this, we can conclude that gold is the best metal in terms of mitigating market volatility, as it suffers from the least volatility itself and presents stability in the long term. Ultimately, all precious metals studied present safe haven properties in the short term and thus offer investors a method for hedging against market volatility.